Well, welcome back to all the VITA volunteers with the Central Arizona VITA Network who are continuing on with our tax law training class. In the last session, we talked about tips to conducting a very thorough interview to prepare an accurate tax return. We also talked about filing status, what determines that, and who should file a return or who must file a return. Now we're going to get really into the thick of it. We're going to start talking about dependents. Who can be claimed as a dependent? What are the different types of dependents? What are the advantages of claiming a dependent? And then we're going to start talking about the various types of income, what income you have to pay tax on, what income you don't have to pay tax on, and how do we put that on a tax return? So let's get started. So here we'll start talking about dependents. Now, as I said before, and as I hope you'll start getting into the habit of it because you will want to do this when you're preparing taxes at a tax site. Grab your 4012 and open it up. Open it up to tab C, dependents, and follow along with me in here because you cannot possibly memorize all these rules. You've got to be able to go figure out how to apply the tax law to specific circumstances and situations. And this booklet will help you do that, I promise you. So on C1 is there's an overview right here of the rules for claiming a dependent. There's two classifications of dependent. There's a qualifying child and a qualifying relative. And hint, hint, they don't always have to be your relative. But these are the two buckets, if you will, that have different rules for each. And we're going to discuss the different rules for that. So, as I said, the dependent can either be a qualifying child or a qualifying relative. The spouse of a taxpayer cannot be claimed as a dependent. You'll see that happen sometimes. They come in, well, my husband didn't work, didn't earn a nickel. I provided all of him for. Why can't I claim him as a dependent? Well, the law says you can't. Okay. But some examples of dependents include children, stepchildren, brothers, sisters, or parents. If they are a qualifying child, they qualify for the child tax credit, which can be up to $2,000 per child. Pretty valuable tax credit. If not, if they're a qualifying relative, they can qualify for up to $500 for that. So there's the kind of the basic advantages of the two different types of dependents. Okay. Here's a big thing. The qualifying child or dependent cannot be claimed by another taxpayer. We see this happen all the time, especially with divorced parents or parents that, the kids live with both of them for some time. We'll go over the rules of what that is, but the point I was trying to make is there can be one of the spouses who's not eligible to claim them, but they're smart enough to go get that tax return filed right as soon as tax filing opens, and they get the credit for the kid, and then mom comes in to file it, and the return gets rejected because it's already been claimed on the dad's return. And whether or not the dad had the right to claim them or not, but this becomes a problem for us sometimes. And there's specific rules, and you're gonna know all of these rules in a bit of how to do it. So we want to start talking about the qualifying child or the qualifying relative test. Okay. So first of all, there's rules for all dependents, whether you're a child or a relative. Cannot be claimed as another dependent. They cannot file a joint return, and they have to have citizenship or residency. And we'll define those rules in just a moment here. Also, if you're a child, there has to be a relationship to the taxpayer. They have to be under the age of 19 unless they're a full-time student, and then they can be up to 24. Or if they're disabled, they can be at any age. You may have remembered one time back when we were talking about all those questions on that first basic information page of preparing a tax return. One of those little boxes are if they're disabled, because that can determine whether or not they could, maybe they're 25, but if they're disabled, they could still be a qualifying child of the taxpayer. Then the residency requirement, they have to live more than half of the year in the house, the taxpayer's house. And they had to have received more than half of their support from the person claiming them as a dependent. Now, a qualifying relative is different. It doesn't have to be your child. So this can be mom or dad. It has to be a member of the house all year. Their gross income, and actually this is a mistake here. I got to fix this here. By the way, this income limit goes up every year. It was $4,700 last year. It's $5,050 this year. And they had to have received more than half of their support from the taxpayer. So those are kind of the basic rules. Now, let's go over some of the real details of it. And again, in your 4012, you'll see 3 tables. And this has sort of interviews. There are questions to ask the taxpayer. And if they respond yes or no, and you don't necessarily have to ask them, you can go by their intake and interview sheet. But, it's kind of a flow chart where you ask them questions. If it's yes or no, then you go to the next step or go to some other step to be able to see that. There's table 1 that's for all dependents. There'll be a table 2 for qualifying relative, and then a table 3 for children or divorced or separated parents who live apart. So get used to using these tables and being able to find the information into them, okay? So let's go over some of those rules, okay? So for all dependents, right, the dependent taxpayer test says a taxpayer who could be claimed as a dependent by another taxpayer cannot be claimed on this return that you're doing. The joint return test. The child can't file a joint return for the year. In other words, they could be married. You got a 21-year-old that lives, 21-year-old got married and him and his spouse live with you, and you want to claim them as dependents, right? You can't do that if they're filing a joint return. The citizen or residency test, okay? They must be a U.S. citizen, or careful, read this careful, a U.S. resident alien, that means they have a green card, or a U.S. national or resident of Canada or Mexico. So, and we see this a lot. We have taxpayers here who are resident aliens, or, meaning they have a green card, or they're U.S. citizens, but they're supporting their parents or kids in Mexico, okay? So they might be able to claim them as a dependent, right? So that's one of the tests, okay? Children who were born, died, or adopted during the year, they count as being there for the entire year, okay? Foreign exchange students cannot be claimed as dependents, even though they might seem to meet all the rules of being a qualifying relative. They lived there all year. The taxpayer provided more than half of their support, blah, 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 meet all the other rules. But if they're here as a foreign exchange student, they can't be claimed as a dependent. Whoops. I already said that a resident alien is one that meets the green card test, but there's another test. It starts to get pretty complicated, and there is a chart that you can use in your 4012. It's tab L, that will help you determine whether they're treated as a non-resident alien or a resident alien if they met the substantial presence test. I won't go over all of that right now, but if you're a lawful permanent resident of the United States at any time, meaning this is what's known as you've got a green card, you're a permanent resident in there, and you're treated as a U.S. citizen for tax purposes. You have to file a 1040. You have to claim your worldwide income for that. This can get a little bit complicated, but for our purposes, we need to determine whether they're resident aliens, U.S. citizens or not. I'll quickly go over this rule, and I'm just going to summarize this real quick. The substantial presence test means that you were here for 183 days during the 3-year period that includes the current year and the 2 years immediately, and there's some complicated calculations to determine that 183 days. Um, a lot of the people we deal with, like foreign students that are here, they're exempt during the first 5 years that they're here. They don't even have to count those days. So they're never going to be treated as a resident alien for that. They'll always be a non-resident alien for this. In addition to now here we're gonna delve into what are the rules for being to be a qualifying child, not a qualifying relative, the first bucket, right? So now there's a relationship test. They got to be your son, daughter, stepchild, foster child, adopted child, brother, sister, half brother, half sister, stepbrother, stepsister, or look at this one, descendant of any of them. So I'm trying to, grandchildren, things like that, they're going to count. Nieces and nephews. Let's see, does that? Yeah, so brother, you got your brother and their kid is your nephew, that would count because that's a descendant of your brother, right? Be careful of the rules under tax laws. They have different definitions under different places for these things. So in this case, you want to be able to turn to page C3, where it says test to be qualifying child, and it lists all of these things right here. Age. They have to be under age 19 and younger than they have to be age 19 and younger than the taxpayer, meaning this is kind of weird. I'm trying to think of it, but sometimes you'll have big age discrepancies in the marriage and anyway, that's not common. So I can't think of a great example to describe where that would come into play. But here's a big one. Under age 24, a full-time student, and then younger than the taxpayer, of course. But be careful here. And here I'm going to point you to what's really important about reading in the 4012 and reading the footnotes in the 4012. For instance, go look at go look at page C5, where it asks here, was the person under age 19 or under age 24 or permanently disabled? And then in the next step, on step 7, it said, did the person live with you as a member of your household except for temporary absences? Okay. Now, there's a footnote there under temporary absences that says 2, footnote 2. And you look at that and it says, a child is considered to have lived with you during periods of time when one of you or both are temporarily absent due to illness, education, business, vacation, military service, and on and on. In other words, this student who's absent doesn't live in your house for the whole time, but is under 24 and a full-time student, that's considered a temporary absence. So, I'm in Phoenix and my daughter might go up to Flagstaff, Arizona to attend Northern Arizona University, and she might live there 9 months out of the year. That's a temporary absence. She's considered living in my house. So I wanted to point that out about full-time students here in this age requirement, because it comes under the next one, under residency test, lived with you for more than half of the year. So those people who are away for temporary absences that expected to return, that temporary absences don't count. Okay. Here's the support test. The child can't have provided more than half of his or her own support for the year. So the child I was just talking about, my daughter who goes up to NAU, if she's there working and she's providing her own support for doing that, and it's more than half of their own support, I can't claim her as a dependent. You see what I was talking about earlier, where whether you can claim somebody as a dependent is not a choice. In other words, my daughter, if she's supporting herself, she can't say, well, I'm letting my dad claim myself. I won't claim myself on my own return. It's not a choice. It's the facts and circumstances that determine who can claim the child as a dependent or whether they can claim themselves. So that's really important here. Now we move to qualifying relative tests. That's that second bucket, right? So the first test is it can't be part of the first bucket. It can't be your qualifying child. Okay, you can't just choose to treat them differently, right? So they can't be a qualifying relative if they are your qualifying child, okay? Now, they have to either be a member of the household or meet the relationship test. So if they're a relative, right, they didn't have to live with you all year. They could have lived with you more than 6 months. And here's the relatives, right? But what happens when, your old buddy from high school, gets kicked out of the house, loses their job, and they say, hey, can I stay with you for a week or something, crash on your couch? And they end up staying there for a year. Well, you might be able to claim them as a dependent if they meet all the other rules. But if they're not a relative, if they don't meet the relationship test, they had to live the entire year, all of the time in your household. Very important distinction. Okay. Other things. Here's where most people will fail that. They've got somebody who lives with them, but they have to pass the gross income test, meaning their gross income has to be less than $5,050. That's where most people, they'll come and be crashing on your house, but they're working. Hey, they're trying to get back on their feet, but they're working, and it doesn't take much to get to over $5,050. And that's where they failed at. Then the other step here is the support test. The taxpayer had to provide more than half the support. Now, if they're living in your house, chances are you're providing more than half of your support. We'll show you how you could determine that. But if you're paying for all of the household bills and the rent and the utilities and everything, chances are you've provided more than half their support. So here again, what constitutes a relative? And I'm going to go back to this rule back up here. I went back 2 slides. This rule says they had to be a member of your household or relationship test, right? So member of the household, they don't meet the relationship test. They have to live with you 100% of the time. What's the relationship test? Now I'm going to skip down 2 slides. Okay. Here are all the relatives that could qualify. And it's pretty broad, right? I mean, it's pretty expansive list of relatives. But if they're not your relative, they had to live in the house for the entire year. Okay, I think I've kind of gotten that point. Well, what happens with children of divorced or separated parents? Who gets to claim them? Well, you got to determine who provided over half their support. That can be a little complicated sometimes. Here's a big one. Who has custody? Meaning, when the courts granted the divorce, who did the courts give custody to, right? Now, I'm going to stop right here, and I think I've got other slides that'll reinforce this point, but this is an important point. If the court awards custody to one parent, okay, and that child lives with that parent for more than 6 months during the year, they are the custodial parent. They get the dependency exemption. They get to claim them as a dependent. They are the custodial parent, okay? The only way, now often court decrees, this is very common, court decrees will say, okay, yeah, the wife has got to pay the husband child support and blah, 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 but they get to claim them in the even years, and the husband gets to claim them in the odd years, regardless of where they live, right? That's a court decree. Judge ordered that. IRS doesn't care what the court ordered, okay? If the child lived with one parent for more than 6 months, they are the custodial parent, and they get to claim the dependency exemption unless they release that exemption. And that they do that with this Form 8332. And then the non-custodial parent who is claiming the kid, they've got to attach that to their return. There can be other defining things too, such as who has a greater AGI. We'll talk about that in a slide coming up, right? This one right here. What if you're the qualifying child of more than one person? I mean, it's conceivable that the child of mom and dad, they lived exactly 6 months with one and exactly 6 months with the other, right? There are benefits. I should preface before we start talking about the details of how to figure that out. I should preface it with this, what this slide says. Only one person can claim the child as a qualifying child for all of these tax benefits. They cannot be split, okay? One is a dependency credit. That's the child tax credit. Second is head of household. They can't both be head of household. Only one of them can. The credit for child and dependent care expenses. Even though they might have lived evenly among two households, only one gets to take the credit for child and dependent care expenses. So, only one gets the child tax credit, only one gets the earned income tax credit. So how do you figure that out, right? Well, if the child meets the rules to be the qualifying child of more than one person. Now, I was using the example of two, divorced people. It could be different. It could be, and in fact, one of your situations in the tax returns or one of the scenarios that you have, it's not in the tax returns, it's in one of the scenarios in the test, talk about grandma, mom, and child who all live in the same house, right? Who gets to claim them? And when you start trying to apply all the rules, well, it looks like, hell, it could be either mom or grandma. And so now you got to go to the tiebreaker rules. And those tiebreaker rules you can find on C4. And I'm going to give you a little hint for the test on that scenario I just gave you. Be sure to read these carefully, including the examples that are on that page on C4 of your Form 40 of your booklet 4012. Those are the tiebreaker rules that will go down. And here's where sometimes the adjusted gross income might be the tiebreaker. Okay. These are not common that you're going to come across it, so I'm not going to spend a lot of time in going all over them. You just, once you hit this, you got to hit the books, pull it out and read very carefully. And don't hesitate to get your psych coordinator involved as well. There are special rules for divorced or separated parents that provide exceptions to this. And you can find those rules on page C8 for that. But generally, what I was telling you earlier, okay, I'll get to it in a couple more slides, about when you determine which one has the ability to claim them, they can release the exemption, but only if they file that Form 8332. So you may have been wondering, well, how do you determine who provides more than half of their support? Well, in your 4012 on C10, there's a little worksheet that you can go through that helps you determine it. Okay? It's actually on C9 and C10. This can be very complicated, and I'm not sure I would go through this unless you really can't determine. Generally, as I said, if you're paying all the rent and bills and buying the groceries, I mean, it's just pretty clear cut. You're providing more than half their support. But it could be that they're living, maybe they lived with grandma a third of the year and dad with a third of the year and with you a third of the year. Then you might have to kind of hit the books here and figure out who really provided more than half of their support. Here is the tax layer screens that you're going to get to, where you're putting in a dependent, right? And here's where you're going to put in the dependent information and their social security number. You'll choose the relationship. How many months did they live with you, right? And there's a little note down here, and this is really from an older screenshot, but it's the same screen. It'll say if the dependent was born in 2024, you must select 12 months. So even if they got born in December 2024, they're considered your dependent all year. But then you've got these little check boxes down here. So be careful, right? Were they over 18? That means 19 and more, and a full-time student. Were they disabled, right? Remember all those rules I was telling you that apply to students and disabled people, right? Maybe this child lived with you and you signed that Form 8332 and gave them away to, your other spouse. So you're going to check this box right here that says, check if this qualifying child is not your dependent. Okay. Once you've entered one dependent and you click continued, you'll be back at this screen right here, and then you can click add a dependent or qualifying child. Okay. So let's talk about special rules for divorced or separated parents. Okay. As I said, the custodial parent is the one who has custody for the greater part of the year. And in IRS's rules, that is the person who is entitled to the exemption. Even if, look at this one, even if the non-custodial parent provided more than half of the child's support. If they lived with one, they're the custodial parent and they're entitled to the exemption. Now, as I said, if the child received over half of their support from a third party, neither parent can claim the child as a dependent. Okay. But the custodial parent can agree to allow the non-custodial parent to claim if they sign the Form 8332. Now, often what happens is that Form 8332 has a place on it to where they can say, I release the exemption for all even numbered years starting with 2018 going forward, right? And so the non-custodial parent keeps that copy, and every time they file the return, they attach that copy to the return. Or they might say, this is for 3 years or whatever, so that the non-custodial parent doesn't have to hassle the custodial parent every year. So that's common. You may run into, in fact, you're likely to run into people have said, well, hey, I always just attached my divorce decree that said I'm entitled to the exemption on there. And that used to be good before about 2018, but it hasn't been good for like 6 years. They should know that by now, but maybe they've been doing their own return. I don't know, but doing that, but that's not the rules anymore. They've got to attach that form that's signed by the custodial parent. Okay, I've pretty much, I said 2018, it was 2008. So most people are aware of this now. It's been quite a while. I'm kind of showing my age, I guess. You cannot remember all of these rules. I've been doing this 30 years. I got to go look them up, right? I mean, you got to learn where to go look for them. And that's what I'm saying. Get really familiar with this tab C in your Pub 4012. Go through the tables to make your determinations. Get comfortable with using these charts, and you'll be sure you make the right decisions every time. There's also a toolkit. I'm not going to spend a lot of time on this, but we've got 3 or 4 screens in this. You can find this toolkit by right down here. If you could Google Colorado tax aid. Aid is spelled AID. I don't know if you can see this, probably not on the screen, but it's pretty easy to find. If you just type in Colorado tax toolkit, you'll be able to get to the screen, and it's got lots of good little tools. Okay. One you're going to find later on when we start talking about annuities and pensions, and you've got a pretty difficult return that you've got to calculate this. I'll go over it later. There's one tool. I'm going to go down here. Here's this dependent qualification calculator. Here it'll ask you lots of questions, just like the 4012 will, and it's using those charts to calculate who gets the dependent. So you could use that if you get kind of confused in the 4012. There's other things in here. I've used this EIN. EIN is an employer identification number. And sometimes we get people coming in who haven't filed their returns for several years, and they bring in IRS transcripts. And the transcripts have the W-2 information, but they don't have the employer identification number, and TaxSlayer requires that. So sometimes we have to go searching for those. So I found this to be. If you really don't like using the worksheet in the 4012, here's where you could get the support worksheet. There's other tools that are in this. I would get comfortable with using it, that good. Okay, let's talk about some other practice tips about dependents. I already mentioned this. A taxpayer could claim a child or a family member who lives in Mexico. If they're providing over half their support, and they paid all the expenses of keeping up the household, they're temporarily away, they're going to come back, it's possible that they could claim them. This is a big one, the second bullet point. You've got a parent who lives in a retirement home, and you're paying the cost of that retirement home, or even just more than half of the cost of that retirement home. You get to claim that. A taxpayer might be able to claim an adult child. Your 28-year-old son loses his job and comes back to sleep on the couch, and as long as he made less than $5,050 a year last year, you might be able to claim him as a dependent. So keep those things in mind. Okay. Here's some examples. Maria and Tanya live together, but are not married. Tanya's son, baby Zeke, lives with them. Dave is not baby Zeke's father. Tanya made no money last year and is not required to file a tax return. Who can claim baby Zeke? So put this on pause, go into that 4012 and see if you can answer that, and then come back and restart the video. Because Tanya is not required to file a tax return, Dave may claim baby Zeke as his qualifying relative. Zeke lived with him all year, right? He may also be able to claim Tanya as a qualifying relative if Tanya lived with him all year, and she didn't make more than $5,050. Okay. Here's another one. Marie, 18, earned $5,000. Her father provided more than half of her support. If all the other dependency tests are met, can her father claim her as a dependent? Put the video on pause, go dig into your 4012, and come back and start it. And the answer is because Maria is under 19, we use the qualifying child rules. So the gross income test does not apply. Her father can claim her as a dependent. Okay. Let's look at a few Arizona specifics about dependents. And I find a lot of professional tax preparers miss some of these things here. Okay. So here is a TaxSlayer screenshot of the basic information of an Arizona return. Now, here's where what you want to look for is, do they have a parent that lives with them? And they call this qualifying parents or ancestors information. Ancestors seems to be kind of a pejorative term, but nevertheless, that's what they call it. And, you've claimed them on your federal return because they're a qualifying relative. So you start with this question right here, begin. Go ahead, don't skip this. If they've got a parent living with them, go through this worksheet. Click on begin, okay? And it's going to ask you some questions, but it has to be the parent or grandparent of the taxpayer or spouse. They had to be 65 or older. They had to live in the taxpayer's principal residence for the entire year. They must be the qualified dependent on the federal return. And here's the big and, okay? And this can be a little bit uncomfortable maybe, okay? But look at this. They must have required assistance with 2 or more categories of activities of daily living. So you've got to be able to ask the taxpayer, well, hey, I see your mom lived with you, right, for the entire year. Okay, how old is she? Yeah, she's over 65. Did you help her do any of this stuff? Did you go shopping for her? Did you help her dress, help feed her? Did you do all the housekeeping for her? Did you help her with her personal finances, right? You got to ask these questions because if they needed help with two or more of these, then you're going to get a big exemption on the state tax return. You're going to get a $10,000 exemption, meaning you can reduce your income by $10,000 instead of getting the dependency exemption, which on the Arizona return, it's a credit and it's only worth $50, right? This is way better. Can be worth 10,000, 2%. It could be worth up to $200. Okay. So if you were in class, I'd ask if you had any questions. You don't have any there. So let's look at a couple of more things. We're going to start looking at income, but just to give you an overview, you don't need to memorize this. TaxSlayer calculates the tax, but sometimes people are going to ask you, well, hey, I was thinking about taking on this other job. How's this going to affect my tax return? And you look at these, we didn't even list up these rates here because they're way higher. They're for higher income than we would ever deal with, right? But if somebody's got taxable income of over 47,000, they're going to take on a second job, right? They might have a pretty good tax liability. And let me explain why, okay? If you're a single filer, your taxable income is 58,000, then the first 11,600 is taxed at 10%. Then the income between 11,600 and 47 is taxed at 12%. The remaining amount between 57 and 151 is taxed at 22%. I'll go back up to that screen. Those are those brackets we call. And the brackets are progressive. As you make more money, you get a higher rate of tax. But it's the money on the next dollar of income. So in this case, if I said they're at, where are they at? They're at 58,000 now. And they say, yeah, I'm thinking about taking on this extra job. I'm going to make an extra $10,000. Well, how much taxes are they going to pay on that? And the answer is they're going to be taxed at 22%. They're going to have to pay $2,200 of tax on that extra income, when really they look at their return and they're only paying an average after their standard deduction and all of that. They're only paying 10 or 15%. But people get surprised about that. Okay, now we're going to really start talking about income. And let me give you, here's the basic formula for income, the overall concept. You look at income, and first of all, I'm going to tell you that anything that makes you better off is considered income. Keep that in mind for a minute, because I'm going to come back to that in a little bit. Then you get to subtract what we call adjustments, and we're going to go through what those adjustments are. Adjustments lower your income to where you get to that term called adjusted gross income, or we call it AGI. And we're going to find that that's an important number because a lot of other deductions or credits or other things look to that number of adjusted gross income. So sometimes an adjustment reducing your income, it reduces your adjusted gross income. But then we look at deductions, such as a standard deduction or itemized deduction or whatever. Then that reduces your AGI down to taxable income. But a deduction does not reduce your adjusted gross income, still stays at that amount, right? It can reduce the amount that you have to pay tax on. But so in general, adjustments are better than deductions, okay? We're going to spend the next few sessions talking about all of this stuff here too. This models the tax return, okay? So this is kind of looking at a tax return. Here you're listing all of your income in this box, right? Total income. Then here we get to subtract your adjustments. Then we get down to adjusted gross income. Then we take off your standard or itemized deductions, and we get down to taxable income. So that formula models the tax return that you see here. Okay, as I said, here's the general rule. All income is taxable no matter how derived, unless it is specifically excluded by the tax law. So now go to publication 4012, go to tab D, and right there it's going to, table A is going to give you examples of taxable income. Now, I think it's easier just to think of everything as income unless it's excluded. So I really want to know what's not taxable. And that, if you turn the page and you go to D4, you get, here's examples of non-taxable income. And they're a lot less, and many of these are really rare, right? I'm going to spend a couple minutes here and talk about the main things we come across that are not taxable, okay? So, child support is not taxable. If you get money from a lawsuit, unless it's punitive, right? Meaning, okay, those are like those big awards where they're punishing a big corporation for doing stuff and they award you 5 million. That could be taxable. But if it's just compensating you to help you fix your car from an accident and give you money for the time you lost for work and for some pain and suffering, right? That's not punitive. That's compensatory and it's not taxable. Okay. Death payments. Federal income tax refunds. You get a refund on your taxes. Well, you know, maybe it's common sense that that's not taxable because you already paid taxes on that money. They're just giving you back the money that you shouldn't have had paid taxes on, right? Here's the big one, big two of them, gifts or inheritances. Okay, if somebody gives you money with no expectation of something in return, that's a key thing. That makes it truly a gift. It is not taxable. Now, you've heard, oh yeah, there's a gift tax. That's for very wealthy people, okay? It won't apply to any of us, and I won't spend the time here talking about it. The other part of it is inheritances. So, man, you inherited $1 million from grandpa, okay? That is not taxable, okay? That's great. Lots of other things here. Let me kind of just see. I think maybe in your test booklet, there's something about qualified Medicaid waiver payments. Qualified Medicaid waiver payments are payments to you if you live in the household and you're taking care of somebody who's disabled and Medicaid is paying you to help take, but you got to live in the household for it, then those payments aren't taxable. Okay. Here's one of the big tax-free things that if you rent out your home, you know, the Super Bowl comes back to Phoenix here, you rent out your home for less than 15 days and make $5,000, not taxable. Okay. Social Security benefits. We're going to talk a lot more about this. A portion may not be taxable. If you don't have any other income, it is never taxable. But as you start having other income, then a portion starts to become taxable. We'll spend a little bit of time on that. Veterans benefits are not taxable. Okay, welfare payments are not taxable. So those are kind of the big ones that you're going to see. Now we're going to talk about earned income. And there are different buckets of income. There's earned income, there's portfolio income like dividends and interest and things like that. There's income from the sale of stocks and bonds, that type. But this is important to understand what is earned income because especially for the clients we serve, they might be entitled to an earned income tax credit. So earned income is kind of what it says. You know, you went and did something for somebody who paid you for it, right? You actually performed some kind of service for that. I mean, you know, you can say, well, I earned interest and dividends on my stocks. That's earned income. No, the only thing you did for it is invest money. You didn't provide any services, right? That's the kind of distinction I want you to take away from this, okay? Unearned income is interest and dividends, retirement income, Social Security. You know, you might say, well, man, I worked 30 years to get that Social Security. I earned it. But no, once you stop working and you collect Social Security, it's not earned income. Unemployment benefits, alimony, child support. Oh, scholarship exceeds educational expenses. We're going to talk a lot a bit about there can be some scholarships that you have to pay taxes on. So here's an exercise. Tony received the following types of income. Which income is exempt from federal taxes? Now, you can turn to page D4 in your Hub 4012, but I think I kind of just explained this. So I'm going to go forward here, and it's inheritances. If I go back to that, tips are taxable. You know, and you might get somebody might come up and say, "Hey, man, these are gifts, right?" You know, that. But if it's earned, if they're given to you in the scope of your employment, and I'll tell you where this came about. The 21 dealers in Las Vegas years ago, like in the 60s or 70s, they took this all the way to the Supreme Court. They were saying, no, these are gifts because, you know, I was lucky for the dealer, right? And they fought it all the way and they lost. Okay. They have to pay taxes on their tips. Okay. So here is the income screen in TaxSlayer, right? And these are the types of things that we're going to go over for the rest of this session. Form W-2 is the most common one right there. There's where you would start entering Form W-2. We're going to learn about 1099-Gs, right? Those could be, you're going to get income tax refunds or unemployment insurance. It could be a lot of things like that. Schedule B is where we put in interest and dividends. 1099-Rs, RRB, and SSAs, this is retirement income. Social Security, pensions, annuities, things like that. Most of these other things, by the way, unemployment has its own 1099-G box here. Okay. Then we're going to have 1099 miscellaneous. And a couple of years ago, they split this out to be a 1099 miscellaneous for miscellaneous income and then 1099 NEC for non-employee compensation. When you hear somebody said, well, I got 1099 for doing this work for that guy, right? That means he was issued a 1099, it got reported to IRS, and now IRS is going to want to see, by the way, this 1099 NEC goes on a business return on Schedule C. You may have heard in the news about Form 1099-K. We're going to talk about that. Schedule E is for rents and royalties. The only thing we'll ever use Schedule E for is if they got royalty income that's reported. We do not do rental income. Schedule D is where we do capital gains and losses. We never do income from farming. And sometimes, in fact, even in the tax returns that you're going to have to do, you'll have to access this one here for other income. Other income is like K1 earnings, gambling winnings, right? Yeah, you got to pay tax on the gambling winnings, right? Cancellation of debt. So if for some reason, you know, the credit card company, you can't pay the bill and, you know, they just finally said, okay, we're going to write this off. You don't have to pay us. Well, remember when I described that income, all income is taxable and income is described as anything that makes you better off? Well, if you didn't have to pay that $1,000 back, they forgave that debt. It's as if somebody gave you $1,000 to pay that off. You're better off. And yes, it's taxable. In most cases, there's a few exceptions. In fact, in tax law, there's exceptions to everything almost, right? But that's the general rule. So W-2, wages, I kind of talked about this. Oh yeah, okay. Tip income, dependent care benefits shown on W-2 is considered earned income. And this one right here, these would be those Medicaid waiver payments. And even though they're not taxable, you can elect to have them counted as earned income to help you increase the earned income tax credit. Here, for all you new preparers, I'm going to tell you right now, if you run across anything about Medicaid waiver payments, get your site coordinator involved, okay? Scholarship income, okay? This is unearned income. Unless they worked for it, like sometimes you'll get, scholarships that are tied to, you had to go teach classes for it. If they provide that on a W-2, then it could be considered earned income, but otherwise it's unearned income. And if there's any scholarship that is more than your qualified educational expenses, which means books, school supplies, etc., tuition, that it's got to be reported as income. For instance, they give you extra scholarship to help you pay for room and board or travel or something like that. Room and board and travel are not considered qualifying educational expenses. So we'll discuss that in detail when we get to education credits, okay? Whenever they present any income documents, like a W-2, a 1099-R, 1099-INT, this is for interest. This one's for dividends. This is for Social Security. You've got to input all the information that's on that document, okay? If you see it, key it. Make the taxpayer form look exactly like the paper form sitting in your hand, okay? So here's an example of a W-2, wage and tax statement right here. So all these boxes, and in the tax layer screens, these official forms can look very different. In fact, you get a W-2 and it doesn't always look like this, right? Used to. But they'll all say box 1, wages, tips, and other compensations. Box 2, federal income tax withheld. It may just be a sheet of a listing of that, but they're all going to say, they have to say box 1, wages and other compensations. Box 2, box 3, blah, blah, blah. And so we use that information to input it into TaxSlayer. We always check these boxes. We always put in all of these codes that are there. If you see it, key it. Here's where you get an example where there were Social Security tips that were reported on a W-2. Here's where there were allocated tips. You don't see this very much. Allocated tips is when, all the employees don't claim enough tips, and then the employer, they have to allocate so many. And in these days of credit cards now, that this has pretty much gone away. When a client has an ITIN, remember we discussed that in the last session too. They have an ITIN, and so that we put that on the basic information screen, but then they get a W-2, and the W-2's got a Social Security number. So then in here, it's called the ITIN Social Security number. We put this in. IRS wants to track that because there's been a lot of misuse of Social Security numbers, right? So anyway, 1099-G, usually you'll see this, and here in Arizona, if you get an Arizona tax refund, it could be taxable if, and only if, you itemize deductions in the previous year instead of claiming the standard deduction. Now, there's 2 things I want to say about this. First of all, 95% of taxpayers, ever since the Trump Act came in, the taxpayer, TCGA, the taxpayer, can't remember the initials, Tax Cut and Jobs Act, TCGA. Ever since that came into 2018, it doubled the standard deduction, and hardly anybody is itemizing anymore. However, that being the case, you could find somebody. Arizona will allow you to itemize on their return, even if you take the standard deduction on the federal return. That's because Arizona doesn't have a limitation for medical and dental expenses. They allow all medical and dental. So you may come across this time to where you itemize on the state, but not the federal. Now, if you itemize on the state and you take a deduction for state income taxes, and then you get a refund of those taxes. Well, you never should have claimed that much. And so therefore you've got to pay tax on it. Arizona stopped sending out 1099-Gs, and we have to go look it up online. So here's the bottom line. First of all, look at the prior year tax return. If they did not itemize deductions, ignore it. Okay? If they did itemize deductions, there's a TaxSlayer worksheet where you have to go put in information and they'll figure it out. Okay? And by the way, if you've got the previous year tax return, you know what the refund was. Okay. This is what the old 1099-Gs used to look like. And you will get, again, if you get unemployment, you're going to get a form that looks like this, and it will say box 1, unemployment compensation. Here's where you would have put the refund of local income taxes. Sometimes when you're getting unemployment compensation, they will withhold federal income tax. So be sure to be careful and look for that. Where does interest income come from? Well, it comes from bank accounts. It could be maybe you lent your buddy $5,000, right? And you charged him interest. You didn't get a 1099 INT from him, I can promise you, but if you earned interest income, you got to claim it. Okay. Most of the time we get a form 1099 INT that tells us what the interest is. And here's what it looks like. It could look different. I'm warning you about this. I mean, they started to put things in different formats. It could be just a listing, but it's always going to say box 1, interest income, box 2, early withdrawal payment. Oh, hint, hint, watch out for this. This is an adjustment to income. And as long as you input it properly in TaxSlayer, they'll account for it. One of your tax returns in the certification exams got one of these with early withdrawal payment. This gets overlooked a lot. This is why we keep emphasizing if you see it, key it, right? Same thing with this. Here's the screen in TaxSlayer where you're going to put in interest income. And again, the TaxSlayer screen is going to say the same thing. Interest income, box 1. Early withdrawal penalty, box 2. Foreign tax withheld, box 4. So in whatever format that form comes in, it'll always say box 1, 2, 3, 4, 5. That. Use that as your guide as where to put this in. Okay, so here's an example. Maria and her husband Arturo, they've got 3 forms. 1099 interest from the state of Washington, bond interest for $300, Desert Financial Credit Union $600, Western Savings and Loan $960. How much income should they report to the feds? Okay, I think most of you are going to pause this and go out and just add up those 4 numbers. Well, I'm going to give you a little hint. Go look under non-taxable income, because one of these things is in there that's under non-taxable income. It's $1,560 because state of Washington bond interest is not taxable on the federal return. Okay. Here's a form for dividends, which pretty much models the interest form. And it's the same thing that you're going to input into TaxSlayer, only you're going to choose 1099 DIV instead of INT. Here's the TaxSlayer screenshot. Again, it looks very similar. Nothing fancy about this. Here's an example, though, of a 1099 DIV that's in a different format. It doesn't come with all those little boxes in the form, right? But it's still got exactly the same information. Box 1A, ordinary dividends. Box 1B, qualified dividends. Be careful here, because this box 1B, you might wonder, what are qualified dividends? Well, they're dividends that get taxed at a different rate than these dividends. They're a part of ordinary dividends. This is a subsection of it, but TaxSlayer knows how to handle that. And then they calculate the tax at the lower capital gains tax rate. Always be sure to look for total capital gain distributions. And don't forget foreign income tax paid. So now we get to 1099 miscellaneous. And when I first kind of introduced this, up until about 3 years ago, whenever somebody did miscellaneous work for somebody and they didn't pay them as an employee, meaning issued them a W-2, they gave them a 1099. And it came on a 1099 miscellaneous. But there was a lot of abuse with this, and IRS decided to split this form out to where they now have a 1099 miscellaneous, which is just for miscellaneous income. And then the 1099 NEC is for compensation income. So right here under the miscellaneous, here we'd have rents and royalties. I told you a minute ago that royalties, if it comes on a 1099 miscellaneous, we can enter that, and that'll go on a Schedule E. That's the only time we're going to prepare a Schedule E. Often you'll see this like other income. Here's an example. I work at a site at Scottsdale Community College on the Salt River Pima Maricopa Indian Reservation. And so a lot of Native Americans, they get what's called per capita income from the gambling revenue, and it comes to them as other income. It's not subject to self-employment tax. It's not earned income, right? But we report it under a 1099 miscellaneous. Sometimes you get prizes and awards. You know, that it's not earned income and it's not subject to self-employment tax. You didn't do any work for it, right? And it'll come on a 1099 miscellaneous. The 1090 NEC, though, is box one, non-employee compensation. This is when you go work for somebody, and ideally, there's a lot of rules. I'm not going to go over all of the rules, but the general rule says if the person you're doing the work for controls how, when, and where you do the work and provides you with tools for doing it, they've got control over the work, they're supposed to count you as an employee. Not all do, right? On the other hand, if they tell you, look, I got this job I need you to do, I need it done by next Wednesday, and you provide all the tools to get it done. You just get it done and I'll pay you $4,010. Well, that's truly non-employee compensation, okay? And that compensation means you're now in business for yourself, and you have to go report it on Schedule C, income from a business. That's what we're saying right up here, okay? So now we talk about business income, okay? What is business income? It can come from many different sources. It could be cash receipts. It could come on a Form 1099 NEC, but not always. Be careful, because you will have clients come in here and say, well, yeah, I said I made less than $600 and they didn't have to give me a 1099, so I don't have to report that income, right? Wrong. You have to, okay? And now once you do this, you have to put it on Schedule C, and now you become a self-employed independent contractor. And all your income now is subject to self-employment tax. That's a big surprise for some of these clients, okay? Now, sometimes if it's just a one-time payment off the wall thing, you really don't need to claim the self-employment. But ask them what they did because sometimes people will report it on a 1099 NEC, and it really should have been reported on a 1099 miscellaneous. So ask them what they did. Ask sufficient questions. Did you really conduct a business? Do you have records to support income and expenses, or can you reasonably reconstruct the income and expense records? We get lots of people who come in here and they realize, yeah, okay, I've been running a business. Yeah, I've been spending a lot of money. They haven't kept records. And sometimes we've got little forms we can give them to help them count it up. And sometimes we send them away and say, hey, go look through your credit card statements or bank accounts and find all of these places, because this can really help your tax situation, right? And then we report these income and expenses on Schedule C. We do not audit these taxpayers. We take their word at what they do. Now, that said, I've said this before in these, if you feel that they're not being honest with it, you don't have to prepare the return. if they're really giving you reasonable estimates of stuff, you can go ahead and prepare the return. But I always tell them right then, if you don't have documentation to support the income and expenses and you get audited, you could be in for a big surprise. If you're estimating these things and they're legitimate estimates, go home and document it, right? Pull out your bank records, pull out that, okay? Income from Uber or Lyft should be treated as business income. They're self-employed, okay? And you're going to find that some of this income gets reported on a 1099-K. Some of the other income will be reported on a 1099 miscellaneous, right? It's still all Schedule C income. Here's a 1099-K. Now, you've probably heard a lot about this in the news, okay? The first act that Biden put in, the income IRA, the Income Reconciliation Act, I forget what it is, what it said. They started saying, it used to be before 2001, I'm sorry, before 2021, that 1099-K was used for, as it says in this form, for third-party network transactions with huge amounts of income, 22,000 or 2,200 transactions, I forget the exact number. But these were for these big sellers that were selling stuff on eBay and not reporting their income. So IRS said, no, we got this 1099-K. We want to identify these people who are running businesses on, these third-party networks. Well, Lyft and Uber are third-party networks. They're just facilitators, right? They facilitate your car with that client. That client has his credit card number, and they facilitate the credit card transaction. They're a third-party network transaction. So they would report this, your Uber income or Lyft income on 1099-K. Now, the Income and Reconciliation Act said, okay, that's too high of a thing. We need to lower this down to 600. And people started realizing, wow, hey man, I Venmo'd my friends, to pay for lunch and stuff. And now Venmo's gonna be sending me, or sending them saying that they received more than $600, and IRS is gonna think they're in business for themselves. Big old brouhaha. And so the first year in 2022, they said, no, we're not going to do that. In 2023, they raised it to, I forget what. This year it's 5,000. I think it goes down to like 2,200 next year. And then by 2026, it's going to be down to $600. Okay. So they're trying to encourage the vendors like the Venmos and the Zells and the eBays to have customers identify their account. Is this for personal use or business use? So that then they could satisfy. In the meantime, we're going to have to deal with these things. Okay. And here, this is, again, taxpayers may not receive the Form 1099-K if the amount is less than 600. That doesn't mean they don't have to pay tax on it. They have to give us a reasonable estimation of what they did. Maybe they only went out and drove one day and said, oh, I'm not doing this anymore. Okay. Oh, okay. So here's what I was trying to remember. In 2022, the limit was 20,000. In 2024, it's going to go to 5,000. That's the year we're doing, and more than one transaction. Then next year, it's going to go back. It'll go down to like a couple thousand, and then finally, they're going to reach the $600 level. 4012 limits the types of 1099-K income, because now if you go to that out of scope thing, or better yet, go to the one little cheat sheet of out of scope things, right? One of them that's on there says if they have inventory, we can't do their return. So if they're selling stuff on eBay, here, no, he's not even related to me. My stepdaughter's friend, her son has like become a guru at this. He's like a senior in high school, and he goes out to all these Goodwill stores and he knows what's in fashion, and he picks his stuff up and he sells them at a huge profit on eBay. Okay. He's got inventory. He's buying stuff, holding it in his garage till somebody buys it on eBay. We can't do his return. If they've got inventory, we can't do it. If they do swap meet stuff, that's the same thing. They got inventory. We can't do it. So you see why this could be. Now, sometimes somebody is going to get a 1099-K and they're going to say, I didn't do any business for this. I got this because I was sending my son money for, I was Venmoing him money to pay for his rent in Flagstaff, right? It was all personal. There is a line on the 2024 tax return where we can report 1099-K transactions that were for non-taxable transactions. So there is a way we can account for it. Again, get with your site coordinator to do that. Personal reimbursements and gifts are not taxable. These are the kinds of things I've been describing, right? Grandpa sends a cash gift for Christmas. Casual sale of goods and services were those I was describing. You're doing things at swap meet, or you're selling things like my friend's son was doing. Okay. Okay, we've kind of talked about that. Okay. Let's talk about deductions now. Here, the biggest deduction that we're going to see here is auto expense, or self-employment, because like the Lyft and Uber drivers, and we see a lot of those, they have mileage expenses. And luckily for us, Uber is tracking their actual business miles, that they were carting people. Lots of people come in that, they're running a landscaping business, and they had a truck and they had to haul their tools from place to place, but the law says they had to keep a record of their miles, and they don't. Okay. So what do we got here as an example? Daryl uses car only for personal use during the 6 months of the year. During the last 6, he drove a car a total of 18,000 miles, but of those miles, only 15,000 were driven to provide transportation for the ride sharing service. So let's see what it looks like here. He can only deduct the business miles. He can deduct other expenses, and here's the standard that IRS uses. He can deduct other ordinary and necessary business expenses, such as supplies, a cell phone, but now careful, cell phone could only be the business portion of the cell phone. He can't deduct his whole cell phone. He's got to allocate it between personal and business use. If he buys food and drinks for the passengers, but not for himself, has to be for the passengers, he can deduct it. Parking fees, tolls, roadside assistance plans, insurance and taxes. Those are all ordinary and necessary for him to be able to drive Uber. When you go into Schedule C, the first thing it's going to ask you for is a business code. And you can click here on this list for business codes, and then you can search it using Control F. That sometimes takes you got to use, your investigative skills. For instance, I think for Uber and Lyft drivers, we're putting in limousine and taxi services or something like no, it says limousine and ride sharing services, but it's listed under L, under limousine. So when you're inputting this into TaxSlayer, right? You start a Schedule C. You started the Form 1099 NEC, and you put that in, and you put in 3942. It's going to take you to a screen that says, hey, do you want to start a Schedule C or use an existing one? So if this is the first Schedule C, you click on that. It starts the Schedule C. It's going to ask you for the business code, and then it's going to take you to this income screen. Now, you've already put in the one that came from the 1099 miscellaneous. However, there is no 1099-K form. So you're going to pull out his 1099-K form, and you're going to put in here the amount from the 1099-K. Plus, he might say, yeah, I got another $650 in tips. You might put in down here. Okay? So what are ordinary necessary business expenses? Here are some examples: supplies, advertising, office expense, commissions and fees, repairs and maintenance. Auto and truck is the biggest one. And when we put in miles, we uh, we have to use the business mileage rate as 67 cents a mile. Now, they may come and dump in a whole bunch of gas receipts and repair receipts, and IRS does allow you to use actual expenses versus mileage, but actual expenses are out of scope for us. We cannot do it. Okay, we can only do mileage. And here's the general rule. This comes right out of your 4012. I forget what page it's under, but it's under expenses and uh, business income. You can find it. If you just look in the index under mileage, right, you'll find this. But this is kind of a good visual of telling you, and I'm going to even summarize this visual for you, right? Driving from home to work is never deductible. That's called commuting. Okay. When you work for an employer under W-2, you don't get a deduction for driving to work. You don't get a deduction for driving home. Just because you're in business for yourself doesn't mean you get to deduct commuting thing. So once you get to your first job location, okay, that first section is not deductible, but then you go to different job locations. All of that is deductible mileage, right? Then coming home is not deductible. You see where it gets difficult, that taxpayers are supposed to keep a record, a log of these, and we need to educate them about this. That doesn't mean that we can say that they shouldn't deduct miles. You know, that they should, but they're signing a return that says that they've got a record for it. So I encourage them, go home and construct a record based on estimates. Use Google, use how many days you were working. Now, if they're Lyft and Uber drivers, Lyft and Uber gives us those miles, right? They've tracked it in their car. So that's a good written record. So all of the following are deductible business expenses except interest paid on business loans, expenses paid for the business use of the taxpayer's home. We do have a lot of folks who come in here and say, yeah, I've been told I can take a home office expense. There are really specific rules, and I will tell you as a CPA, most people do not qualify to take the home office expense. That's why it's out of scope for us. We don't even talk about it. If they want to take the home office expense, they need to go to a paid preparer and do it. Okay. Actually, this says legal and professional services and fees are not deductible. I'm not sure. I would deduct some of those. They are ordinary if they're ordinary and necessary. You got to sort that out, right? You can't go say I paid a lawyer to create a will and call that a business expense, right? But on the other hand, if you did have a tax preparer prepare your return and part of it was for Schedule C, well, that would be deductible. Okay. So kind of ignore this one. A landline telephone cost, the only time it would be deductible if it's the second landline into your home used exclusively for business. Even though you use the first landline 80% for business, it is never deductible. Okay. Oh, I'm sorry. Now I understand why this was. It says all of this is this was an exercise. It says all of the following are deductible. Okay, and expenses paid for the business use of the home I was describing, that is deductible. Interest paid on a business loan is deductible. Legal and professional services fees are deductible, but this one is not. There we go. Okay, less common income. This is the screen from TaxSlayer. When you click on that button that says other income, not reported. So this is where this would be common. We see gambling winnings from Form W-2G, right? Sometimes there's just other compensation you would get, or sometimes you've got other income not reported elsewhere. This is where we would put in scholarship income that's not used for tuition, books, and expenses. Most of these are out of scope, as you can see, but gambling winnings aren't. Now, they're going to come in with these forms W2G that the casino gave them, tell them how much their winnings are. And they're actually going to come in probably with a form that's saying, well, here's how much money you put in to win that money. Here's the bad news. Okay, number one, you are allowed to deduct losses up to the amount of winnings, no more. You can't cause a loss to offset other income. But if you won 2,000 and you spent 3,000, you could take a $2,000 deduction, but only, this is important, only if you itemize deductions. Most people are not itemizing deductions. And even if in that case they have $2,000 of losses, they go itemize deductions and count up all their itemized deductions, and it may only come to 7,000 and they might have a 14,000 standard deduction. It's better to take the standard deduction and just eat the losses. You're going to have to pay tax on all of that gambling income. That happens to us. We see that a lot. Okay. Here's a form W2G. Always, it'll tell you what type of wager. When you input this into TaxSlayer, it's going to ask you what kind of winnings. This was a scratcher. It might say slots or something like that. Again, fill out all the information that's on that W2G and watch out for income tax withholding. If they really want a lot, they're required, the casino's required to withhold income tax. Here's the information that you would get to. You'd have to put in all the payee information, okay? You'd have to put in the state, the type of wager, the date won. If it's got multiple ones, you could combine all the multiple ones into one. If it would be okay. And you could just make this date 12/31 for doing it. Okay. Here's another thing we're starting to see more is because we've legalized sports betting now. And this is saying, well, hey, fantasy sports winnings of at least 600 are reported to IRS. And then they have to send you a 1099 miscellaneous. I don't know why it doesn't come on a W2G. Maybe they don't consider this gambling winnings. I don't know. But for right now, it comes to you on a 1099 miscellaneous. This is where you're going to put it in as other income. It is not earned income, but you could do it. Okay. I kind of already talked about how the casinos give you that win-loss statement. I'm going to also give you another warning. There was an IRS ruling that says you can't rely on that statement that the casino gave you. You have to keep your own records of it, of how much losses that you have. Again, like I say, it's rare that we're really claiming these losses, so I won't go into a whole bunch of this. I already talked to you about this, right? I didn't say this. Senior citizens, and these are a lot of these folks, they go to the casinos, right? And they come in with those W2Gs. That's income. And if there's enough of that income, it could make the Social Security taxable. Okay, I'm not going to go over anymore. I think I've done everything. Yeah, I just talked about how the gambling winnings. IRS withholds on all gambling winnings at a flat 24% rate. Oh, lottery taxes. This is just withholding for lottery taxes. I'm not going to go over much of this. Okay. Scholarship income. Let's go over this. We see this a lot, and it's important to understand this. This is what the educational institution will send the student who gets a scholarship, and many students are getting this. If they get Pell Grants, you may have heard of Pell Grants. It could be on here. Now, the only time they won't get this statement is if they used all of their Pell Grant to pay for tuition. Then they don't even send them the statement. So we look at our interview form and they said, oh yeah, I had educational expenses and all that. We need to get them to get their statement from the educational institution. They can log on and they can print out so we can determine how much income that they had and how much expenses that they had that were applied. Because theoretically, the institution's just going to say payments received for qualified tuition and related expenses. The institution doesn't know all of your related expenses. You took all online courses and you had to buy a computer. That's a related expense. You bought some of your books on Amazon because they were cheaper than the school bookstore. That's a related expense. We need to get information about all of this. But if you end up with scholarships right here that exceed all of your expenses, then you have to go into that other income screen and they have to put it in as taxable. This is on that other, it's under other income, other compensation. It goes in that screen, but it is unearned income. Okay. Here's a little exercise here that says, which of the following sources of income are not reported on line 8Z of Schedule 1? That's that schedule I just showed you right there, right? And here, I'll go back up to it. It says 8Z is other income. So let's go look and see what these things are. Prizes and awards. Now, we're looking for what's not reported. Prizes and awards, gambling winnings, unemployment compensation, jury duty pay. Well, let's go back and look at that form and see what kinds of things would be separately stated here. Business income, rental, unemployment compensation, that goes there. Other income, gambling, cancellation of debt, jury duty. Oh, there's one there for jury duty pay too, right? So I think we're going to see here that there was gambling winnings. Oh yeah, gambling income. So when we look at all of this right here, what's going to be the answer is none of the above. They all have a separate line that they get reported on. Okay. Okay, last section we're going to talk about is income considerations of Native Americans. Okay, and then we're done with this. This has been a long session. Thanks for hanging in there with me. Okay. In Arizona, the thing to think about here is that when we have the Indian reservations, Indian communities, they really prefer to be called too, but those are granted by the federal government, okay? And they are pretty much what we'd call sovereign nations, okay? They're like another country within the country, okay? Now the federal government can tax their income, and they do tax their income. But even though that reservation is inside Arizona, it's a sovereign entity. And Arizona doesn't have a right to tax what goes on inside the reservation. So let's go talk about some of this thing. Here are the different tribes that are in. There's quite a few of them. There's a map, and probably your site coordinators will have a map that show this, right? It's kind of important to know where these tribes are, okay? But here is where a Native American will not have to pay Arizona taxes if they meet all this criteria. They live and work on the reservation. All of their income comes from reservation sources only, and they are a member of that tribe. If they meet all of that, Arizona doesn't have a right to tax them. But they may live on the reservation and work off of the reservation. Well, then Arizona gets to tax it, right? One exception to that is interest and dividend income is not included in Arizona income, even if the bank is off the reservation. Okay, that's kind of trivial and it doesn't really matter. The Native American must live on the reservation and be a member of the tribe. I've already said that. Okay. Gambling winnings can get kind of weird because, if they're part of the reservation where the casino is, and the member, The casino's on the member's reservation. The tribe owns the casino. The member lives on the reservation, and he's a member of the affiliated tribe, right? Arizona can't tax that income. Most of these Native Americans that have casinos on their reservation, they get what's called per capita payments. They get a share of the gambling revenue, okay? And those per capita payments, they're subject to federal taxes. We got to file a return for them. They pay income tax on it, federal income tax. But if they live on the reservation and that casino is on the same reservation that they're a tribe of, they do not have to pay tax on it, okay? Per capita payments can be received by dependents living temporarily off the reservation, like students in college. And that wouldn't be included in the parents if the dependent's parents live on the reservation. I think you're starting to get the idea here, right? You know, if it's all confined within the reservation, that's like England, right? You know, Arizona can't go touch England. They're a sovereign nation. But if they come off the reservation, earn any of the money, or live off of the reservation, then that kind of breaks the barrier, if you will. I already described how that will get reported on the 1099 miscellaneous under other income. And when we put it in tax layer, we just put in a definition or a description that it's per cap. And by the way, this is unearned income, so it's not eligible for the earned income credit. You know, we can describe it as any one of these things when we put it on there, okay? There's also an Arizona excise tax credit that Native Americans who live on the reservation and are affiliated members of the tribe, they still are eligible to file for this Arizona excise tax credit. I'm not sure where the logic of that came from, but it's just something to look at. It's $25 per member of the household. It's not a huge, but to some of these folks, I mean, that counts as money, okay? If they work on and off the reservation, we have to allocate their income. And here's where you want to get your site coordinator involved, okay? Don't tackle this by yourself, okay? Same thing if it's one spouse is a Native American and the other one isn't, then you've got a lot of work to do. Get your site coordinator involved, okay? Now, so you figured out the 1040 return, and then you figured out that all of that income, or you know, some of that income is not taxable to Arizona. Well, you go into the AZ 140 form, and under subtractions, they call it line 31, certain wages of American Indians. Now, it could be, that could be their per capita income. It doesn't have to be wages, but we use that line to put that in. So that way it takes it off of the Arizona return. And by the way, on their intake and interview form on that last page where you can put notes, put a note in here how you treated this, so that if they ever get questioned and they come back to us and say, hey, they're telling me this doesn't work, we know how we treated it. Here's where we're going to go: subtractions from other income, certain wages. This term wages should say certain income of American Indians. Okay. When they come into us, you know, we want all of the information that's normally there, but for their tribal membership, we just take their word for it. Okay, we don't ask for proof of that. You know, if they get audited, they might have to prove it, right? Here are some questions to ask. We've got some IRS resources, and we've also got a VITA resource from Arizona that your site coordinator could help you get that for you too. Okay, so we're coming to the end of this. Here's what I want you to do before the next session, and it won't be session 3. It's going to be session 2. Yeah, it'll be session 3A, right? Is go into your publication 6744. That's the test booklet. Answer the questions for the first 6 scenarios that we've covered in class. Do your best. You might not be able to answer all of them, but answer as many as you can. Start answering the questions in these tests, because then you'll know what questions you have to go research or ask your site coordinator or other folks that you work with to help you with it. Start the returns for Caldwell. I think the names are different this year. Okay. I don't know. Maybe it is the same. I forget. But these are scenarios 7, 8, and 9. Start them and put in the basic information that you can so that you get a start on these things too. So next session, we're going to continue on with income, where we'll talk about retirement income and capital gains and Social Security. And I'm not sure that we'll get through all of it. We'll probably split that into 2 sessions too. And then we'll also do some Arizona specifics for retirement. So good. Thank you for hanging in there. I know that this was kind of a long session, but it just made more sense to cover all of this together. And then I'll look forward to seeing you during our next session, okay? Bye-bye now.